Hi. On June 5th and 6th, 2024, I'll be speaking at the largest AI event in Asia, Super AI, in Singapore, at the iconic Marina Bay Sands. Alongside brilliant minds like Benedict Evans, Balaji, and Edward Snowden, I'll be on stage exploring the extraordinary potential of AI and the profound change it represents not just for financial markets, but for the world as we know it. With over 5,000 attendees and over 150 side events, Singapore will become a vibrant AI hub for a full week from June the 3rd to the 9th. Visit realvision.com/super AI to register and join me with 20% off tickets with the code REALVISION, all in caps.
Will rate cuts come in 2024? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Darius Dale, founder of 42 Macro. Hey, Darius. Always great to see you.
Always a pleasure to see you as well, Maggie. Thanks for having me. Your hair looks amazing, by the way.
Oh, thank you. Trying. It's a struggle. And
None.
welcome to everyone. Welcome to everyone who's watching and who's joining us in the chat. If you are not a member and you are not in our chat, go to the website, join, so you can join us in the chat, because before we even get started, hang on a second. We have Paul. Hi, Paul, who said, Maggie, ask Darius if he wants to announce anything.
Oh,
Like his X post where he floated the idea of running for president.
well, one, I'm not going to allow you to sit there and call it an X post. It was a tweet. Starting one.
Well, I'm just reading what I see, but you're right. Paul's being very, very official.
Yeah. So, I mean, not to get off track on this, but this is something I've thought about for many years now. In fact, when I went to school, I initially thought this was the career path that I would take. But anyway, I've had this very, blessed life experience where half of my life was in the bottom 1%. The second half of my life is somewhere near the top. And I've had a lot of life experiences in between that, kind of allow me to connect with people and understand the plight of the average man and the low to medium income person. So I definitely think there's some leadership vacuum that I'd like to fill in the future. But between now and then, I'm going to be focused on helping 42 macro clients make and save money. So check back with me in 20 years.
Excellent. Oh my gosh. So I was totally thinking he was joking, but this is very exciting. Washington, listen, everyone who listens to the show knows that I always reference a very funny thing that Tommy Thornton said to me a couple of years ago, which is that it's a bear market in political leadership.
Amen.
Being a completely apolitical statement, but just that we have a lot of serious problems. Darius, that's so exciting, and I love that you have that spirit to serve. And I hope you're serious about it. Let's go, Real Vision. Let's continue to get Darius on this path. I love it.
Thank you.
But yeah, it's real. It's very real, and we do need good people to step up. So I hope anyone's listening will consider it as well. And we look forward to following along on this new thread of yours, Darius. But all right, in the meantime, listen, well, at least we'll have somebody who knows something about the damn economy if you get there, because we know that you know that. And so let's start with that, because we are in an election year, and we've had this what seems like really confusing U.S. economy, and we had some cross currents again today. So we had ADP report showed that companies are still adding jobs, but the pace was a little bit less than expected. So nothing too hot. It comes on the heels of a little bit of a soft ISM, but it feels like in all of these econ data points, you can sort of find strength and weakness. You and I talk about that all the time. And then Jay Powell was testifying in Congress today, and he said, basically the headline coming out of it was that the door is open for rate cuts sometime this year, although he once again emphasized that the Fed is in no rush at all. So we're kind of in wait and see mode. So, we know you probably came with your charts. So walk us through your have your finger on the pulse of so many different parts of the economy as you try to assess what's going on. So what do you see happening? Do we know where are we with the U.S. economy?
Yeah, thank you, Maggie. I appreciate that. From what we've been analyzing here for our clients at 42 Macro is that we are now seeing a tug of war emerge between the no landing scenario and the soft landing scenario. Recall that the asset markets pivoted to the soft landing scenario as the overwhelming market consensus over the past few months. Really, that process started in late October once we started to get some positive surprises on productivity, some positive surprises with respect to Treasury issuance and global liquidity. So that soft landing scenario has essentially peaked in market probability terms and is now declining while the no landing scenario is rising. So this tug of war, in our opinion, holds the key to where markets are headed over the medium term. So as you did allude to, I did bring some charts with me. So Brian, if you could start with chart 7, where we show the various components of the ISM services report. Headline, prices, new orders, employment, the breadth, as well as supplier delivery times. And as we could see, on balance, these metrics supported the soft landing scenario at the expense of the no landing scenario. Headline ticked down, prices ticked down. We saw employment tick down below 50, which indicates contraction. But we also saw new orders tick up as well as the breadth tick up. If you go to slide 8, Brian, a no landing is currently the highest probability scenario according to our models, the models that we use to forecast growth and inflation across all the major economies in the world. Well, if you look at our US model, where we show our growth projections on the left of this chart on chart 8, and we show our inflation projections on the right there, you can see that our model has a growth and inflation bottoming at levels that are historically inconsistent with sort of 2% inflation, particularly on the inflation side. We would probably need to decelerate another 100 basis points lower than where our kind of the nadir of our projections are to get a sustained 2% inflation target. And so that, in our opinion, is likely to cause some market risk, but we don't think that market risk is here yet from a trending perspective. Obviously, we may be mired in a correction here, but we don't believe that this current correction, if it extends, is likely to transition us into a sustained risk-off regime, at least not yet. And one of the reasons for that is on slide 9. Slide 9, where we show the ISM manufacturing and services percentage of respondents reporting slower supplier delivery times. Those numbers are back to kind of really cyclically and structurally depressed levels, and that supports the above trend productivity growth that has been supporting the soft landing scenario underpinning this Goldilocks market regime. Another thing on slide 10 that has been supportive of the above trend productivity growth is on slide 10, where we show unpack the JOLTS report that we got today at 10 a.m. The hires rate was flat month over month, sequentially flat at 4%. That is a below trend level relative to the pre-COVID trend. The private sector's quits rate was flat month over month at 2.4%. And so that's supportive of productivity, obviously, because with less turnover, the on-the-job training that you're doing with your employees, obviously that sticks, and you're able to get more productive employees out of that process. And then lastly, we got on slide 11, the reason this is also that low turnover in the labor market has been so supportive in recent months is because it sort of takes the wind out of the sails of the wage inflation. Now, we had a little bit of a backup in wage inflation if you look at the ADP median annual pay statistic for job changers, but obviously overall the trend in wage inflation has been lower across a variety of metrics. And as long as that trend is lower, then Jay Powell's expectation for some rate cuts at some point this year is a reasonable expectation to maintain.
So, Darius, you're one of the few people that has brought up productivity, and it's such an important part of, well, any economic forecast, but why are we seeing high productivity? And for those who are not familiar with why that's important, can you just kind of give us a refresher?
Yeah. So I think there's 2 to 3 things that are kind of really driving productivity, right? Obviously, AI. We don't know what percentage of the productivity growth is contributing to the development and deployment of AI, but we know that is additive at the margins and will obviously lead to more productive employees. But we also know that turnover, as I mentioned, has declined back to at low trend levels, which means that the employees that are currently employed in the labor market are likely to be more productive because they're either retaining their training and or they're just getting better at their jobs because they're staying at their jobs for longer than they have been in recent years. And then obviously going back to the ISM survey, the unthawing of supply chains globally, both in between the manufacturing sector and the services sector. If you unthaw those supply chains, you're obviously able to produce more goods and services with the same unit of labor. So those are the 3 things that are really contributing to above trend productivity growth. And in our opinion, which is why we believe productivity growth can remain above trend for the medium term. Now, I don't know that we're in a productivity boom yet, that we don't have any data to support that from a structural standpoint in terms of a 3 to 5 year outlook. But I do believe from a 1 to 2 to 3 quarter perspective, you can sustain above trend productivity growth, which is very positive because it sustains the. Let me take a step back. The reason productivity growth matters so much and why we have been focused on it so much in our research here at 42 Macro since late October, right before we pivoted to being bullish in early November, is because more productivity you have, the less pressure you have on corporate margins. And less pressure you have on corporate margins, the less corporates need to fire people. So that protects the business cycle. And the less corporates need to pass on PPI increases into CPI and the PCE deflator, which obviously it supports financial conditions.
Yeah, that's where you get the growth without that scary inflationary spiral. And it's why we talk about AI so much, and why a lot of people, when they're trying to figure out what's going on, keep looking back to that period when the internet really took off. So will that provide this kind of productivity miracle, or a period of really high productivity, which would allow us to grow above trend? So that's really important. And I don't think enough people have been. We know the number's been high, and you've been including it in your reports, but I feel like it doesn't get the headline attention that some of the other numbers do. And it's a super important part of the equation here. So that's really interesting. So were you surprised? Do you think that Powell kind of kept that door open on rate cuts because they still think the economy is either going to weaken, or they're going to have to force it to weaken? Those higher rates are going to have to force it to weaken to get inflation back to their target. Is that why they keep it on the table? Because I was sort of surprised to hear them say that, given the mayhem that's ensued previously when they've, introduced the idea of rate cuts.
No, I think the Fed is celebrating what is obviously a very positive cyclical forces, and what are very positive cyclical forces in the economy. We continue to observe trending immaculate disinflation. That theme is ongoing. We've had two hot inflation reports, particularly for the month of January, the CPI and the PC deflator. But one month does not make a trend. The Federal Reserve and Jay Powell stressed this many times over. They're not changing their policy outlook or their forward guidance based on one data point or even two data points. They want to see multiple months of either positive conditions or adverse conditions for them to make a policy pivot. And so I just think it's too early to stick a fork in the immaculate disinflation narrative that's been sort of underpinning their expectation for implementing technical rate cuts later this year. That may change, and obviously, according to our forecast as well as our qualitative research, suggests that that's going to have to change at some point. But we expect that change to be more of a 2H24 phenomenon rather than a 1H24 phenomenon. We see, there's so many positive things going on from the perspective of productivity, from the perspective of U.S. liquidity, from the perspective of global liquidity, that are all very positive for asset markets, and likely to continue to be positive for at least another 1 to 2 quarters.
Interesting. So Mark asking this question, and it's come up, Darius, any risk that the cuts don't start later in the year, as they would be too political to start too close to the election? He said Jim Bianco may have said this, but it's a very common thought that if let me put it this way, the thinking used to be that if the Fed wanted to do something in election year, it'd prefer to do it in the beginning of the year, because they don't like to do anything right around the election, because they don't want to be seen as aiding the incumbent administration, or on either side. If someone's calling for rate cuts, they don't want to be seen to be feeding into that, even if their decision making has nothing to do with it. That had been the thinking. Is there a risk that even if they want to cut rates, they might be reluctant to do so until we get through the election? Do you think that's going to matter?
I don't think it's going to matter to Fed policy. It could matter to investor perceptions of Fed policy. And here's why. So we are expecting the Fed to be able to cut the policy rate, likely starting in June or July. But it's very likely by the time we get to their September meeting or their November meeting that it's very likely that they are forced out of being able to implement incremental rate cuts, and maybe forced into hawkish and higher for longer forward guidance again, if our projections on inflation are actually proven correct. We know that immaculate disinflation is a rare phenomenon in the U.S. economy. In fact, it's never happened before. We've never seen so much disinflation prior to a recession in the history of the U.S. Business cycle. And so that's something that's, again, we should expect that at some point, because we continue to grow, and because we continue to tax the labor market from the perspective of the supply and demand of labor, we continue to see excess demand for labor relative to supply. So we know that at some point, wage growth will stop decelerating. It's not going to go back to 2% and stick there, because again, we still see excess demand for labor. So we know that the immaculate disinflation process is probably going to stop. Exactly what month it's going to stop, that's a fool's errand to try to guess. But we can monitor the leading indicators of that process every single day between now and that inflection to prepare ourselves for that in our portfolios.
Yeah, which Darius has talked about. That's why he has his whole framework that he goes through with us, because he doesn't try to. Nobody has a crystal ball, right? So you're looking for the signals. you just mentioned the business cycle. Doug asking, do you feel that 2022 in retrospect will be looked at as a recession, or is there something different about how this business cycle has unfolded? We spent a lot of time here on RV. You've been on with Raul. A lot of us have been looking at whether there's something different going on with the business cycle. Do you think that there is something going on? Is the recession something that already happened in 22? Is it ahead of us? How are you thinking about that, Darius?
No, no. In 2022 is the summer of 2022 is when we authored our resilient U.S. economy, not the resilient U.S. economy theme that you keep hearing all over global Wall Street. That was us. So no, we don't think a recession happened in 2022. I mean, they may go back and do a technical recession or something like that, but we did not see a broad-based decline in income, consumption, employment that would cause the NBR to, stop smoking their tobacco pipes in their tweed jackets and to tell. No. What we think is happening with this very unique business cycle, which we agree with that characterization, this is among the most unique business cycles in U.S. history. This is why so many people have gotten run over for the past 2 years, predicting, the various economic outcomes and positioning their portfolios according to those predictions. There's been so many things that have happened in this business cycle that have really, truly never happened before in the U.S. economy. Not the least of which is the decoupling of the manufacturing and services sector. Usually they're correlated throughout the business cycle. They've been actually inversely correlated in this business cycle. We've seen significantly above trend goods consumption, while we still see services consumption is actually still on a nominal basis, still below trend, which is unheard of and very unusual. We have seen an excess of demand for labor relative to labor supply. That's never happened before in this time series statistics. So this is something that we're new and we're dealing with here. And then I think the number one thing that we've been talking about with our clients, again, going back since the summer of 2022, is the resiliency of the household and corporate balance sheet. Again, I think I've thrown these statistics out on this program several times, but for those who have not heard me say this, we have $7.9 trillion of cash on household balance sheets. That number's up from 3.5 trillion just prior to the pandemic. Obviously, that was fiscal monetary largesse dumped into the household sector balance sheet. That $7.9 trillion of cash is 5% of total household assets, which is the highest ratio of total household assets since the early 1950s. So there's a tremendous amount of liquidity on the household sector balance sheet. There's obviously a tremendous amount of demand for labor. And so households have been supported by income, both from the perspective of the labor market, but also from the perspective of the cash on their balance sheet. So they're able to spend a higher share of their income relative to previous business cycles. That's why the savings rate, the flow statistic, is so high, because the stock of savings the flow statistic is very low because the stock statistic is actually quite high. We have termed this in our research the West Village Montauk effect. Check out my tweets for that.
So yeah, and if you're sort of if you're listening to that and thinking, God, it doesn't feel like that, those are largely people with assets, right, Darius? That's why it's sometimes if for people who are at the bottom stratosphere or young people, they may not be feeling like that they're flush with cash and that there's all this money swishing around. It hasn't filtered to everyone, right?
No, sure. And I've long maintained that, and I've seen this with my own eyes, that the employer class made out like a bandit during COVID with PPP loans that were forgiven, COVID tax breaks that were unnecessary and useless. I've seen all that kind of stuff. And so, you think about the $600 a month the government was handing out to people on the lower end of the income spectrum. That paled in comparison to the billions and billions and billions of fiscal monetary largesse that we were dumping into the coffers of the elites. And now, but let's not forget here, we're talking about aggregate statistics when we say things like GDP, income, consumption, employment. So we have to include the elites in those aggregate statistics. We don't want to just myopically focus on the people on the lower end of the distribution, like the people like I grew up in the communities that I grew up
Yeah. Yeah. Same. But that's I think it's important to tease that out, because when you hear something like that, you're like, wait a minute, that doesn't jive with what I'm seeing. But that's why that's why. And it's by the way, as we roll into, we're going to do a 2-week series. We're going to start telling you about next week. That's why it doesn't some people are feeling very pessimistic about the future, and we've got to figure out how to get through that. So really understanding what's going on and how those figures match up to the reality on the ground, and where the pockets are that could become real problems are going to be really important as we go forward. So we're gonna work on doing that with everyone over the course of the next 2 weeks. So Andreas just dropped his latest steno signals, and he is looking at the outperformance of the US. As you mentioned, this is an economy that everyone's gotten wrong. It's been more resilient. You've been talking about it, and we're very early on talking about the fact that, listen, this thing is stronger than anybody thinks, and it's not slowing down. So Andreas was looking at that issue, but against the lens of what's happening around the world and what the market's priced in. Let's have a listen, and then we'll talk on the other side.
So the GDP outlook for 2024 in the US is outpacing that of peers by miles now, at least according to the economic consensus. And right now, I kind of get the same vibes myself. But the interesting thing here is that if everyone already agrees that the US economy is reaccelerating, that is probably slowly but surely already baked into prices of US assets. But what if this starts to spill over to the rest of the world? What if the real economy in Europe, in Japan, in China, in the UK starts to show signs of life? I mean, just green shoots here will be relevant for market prices given this divergence in views on GDP growth for this year.
We didn't get to see Andreas there, but trust us, it was him. You can see that full presentation. They're always great on the website. If you are not a full RV member, head over to our website. You can create a profile. And some folks are chatting. We have some regional chats now. There's an RV New York channel, depending on a whole bunch of other ones, depending on where you are. So you can connect to people who are in your area, which is super cool. I'm going to have to jump in those. I haven't had a chance to yet. Darius, so what are your thoughts about that? I mean, it's interesting idea that I thought for a while the common perception was that Europe and everyone were feeling the pain and the US was going to follow suit. Now we're kind of flipping that, and maybe the US has been growing. And what if we start to, as Andreas say, see green shoots around, and then, I guess who's best positioned to have that not priced in? How are you thinking about that global picture?
Yeah, so I appreciate you tossing that to me, because this is exactly a theme that we authored back in January, which is green shoots globally. If you go up slide 12 in today's chart pack, where we show our global liquidity monitor, we use this to now cast trends and key market indicators and try to identify geographic dispersion before it happens. And so one of the things that allowed us to kind of get to this green shoots globally theme was, if you look at the growth features on the left side of the table, you see the composite PMI readings. Every single major economy in the world has a composite PMI statistic that is trending higher right now. Every single major economy in the world has a composite PMI statistic that is trending higher right now. Every single major economy in the world, if you move your eyes over towards the middle of the page where you see liquidity proxy, every single major economy in the world has a liquidity proxy that's trending higher, with the exception of Japan and the US. And so for those of you who are not familiar with our global liquidity proxy, that's the aggregated sum of these countries' central bank balance sheets, these countries' global broad money supply, and each of their FX reserves minus gold. So we run that statistic for every single economy, and then we summarize that to the global economy. And that statistic started trending higher globally in November. And this is something we called out in real time in mid-November due to our macro weather model that we refresh 6 times a day for 42 macro clients to help them stay on the right side of market risk.
So that's so interesting, because I don't know. It just feels like maybe the sentiment hasn't caught up to that yet, because it kind of feels like when we look around, we talk about US outperforming and everything else, especially when you look at Europe just having had such a tough time. So
So here,
are you
you
going
want to
to
know
use
why,
that?
though?
What's that?
You want to know why the sentiment hasn't caught up with it,
Yeah,
right?
why?
Well, in my humble opinion, the average investor is using narratives to construct portfolios and to manage
Yeah.
risk, whereas we at 42 Macro, well, the way we augment what our clients are doing from a risk management perspective is we use the data to construct the narrative and construct the theme. So we're actually doing it in reverse. A lot of investors are kind of waiting around until it's very obvious from a narrative standpoint that most of the global economy is healing. That stuff will take another 2 or 3 months, which is why there's upside risk in those markets.
Yeah, no, that makes sense, because I do think that that's true. So when are we looking for, do you feel like the best news for the US is priced in and there's more opportunity in, say, Europe or somewhere else in the world that hasn't, where you haven't seen this big stock run that we have been in more or less since November?
Yeah, there's a lot priced into the U.S. markets, but who's to say, or what's to say that it's done being priced in? I mean, as long as we remain in a risk-on market regime, and we are currently in Goldilocks, as indicated by our global macro risk matrix on slide 1, Brian. As long as we remain in a risk-on market regime, then it's not all priced in. It'll be fully priced in once we transition out of the risk-on market regime or to a risk-off market regime, i.e. inflation or deflation in our market regime nowcasting process. We don't expect a transition to a risk-off market regime until sometime around mid-year at the earliest. It could come in as late as late Q3, could come as probably as early as April or May. Who knows? But the reality is, based on our qualitative research, which allows us to help identify what the market regime is likely to transition to and when it's likely to transition. Based on our qualitative research, which we think is quite good, we don't expect a really negative outcome for asset markets until the earliest, again, mid-year.
Yeah, that's so interesting. I'm just going to share a tidbit. We did an RVIP session with Katie Stockton, which was excellent. And I just want to share with all of you that we were talking about this because there was a feeling when you push to some of these levels and look at US stocks broadly, look at some individual names, you can guess which ones, that everyone has this feeling that it can't go on. And she said there's nothing bearish about all-time highs. In and of itself, there's nothing bearish about all-time highs.
It's the most bullish thing ever.
Yeah, it doesn't feel like that. And Tony's talked about this, about, people tend to, Tony Rowell talked about it yesterday. It's not to say you chase it. And again, you have to know your own risk profile. You have to be comfortable with your decisions. You have to know when you need your money. But that in and of itself is a storyline that scares people, and they tend to fade it when sometimes that's not always the right decision. Now, again, you've got to do the research. The point isn't to say that all-time highs can continue, but this is what you're talking about with your charts and your research. You follow the signals. You use the framework you built. You don't just sort of look at that one data point that it's at a high and decide that in and of itself is going to be what makes it turn around. That's been coming up a lot, that theme, and we're going to again touch on that as we keep going on. But that's what you've been trying to tell us every time you come on recently: is don't listen to your mind or buy the story you see on Twitter. Look at the framework you build.
Your feelings. Hate your feelings. If you hear one thing from this 30-minute interview today, aid your feelings. They will get you in trouble when operating in financial markets. It's about being systematic. It's about being thoughtful, and it's about being dispassionate if you're trying to make and save money on a consistent basis.
Yeah. You need some rules of the road to go by. So we have a question from Ralph. You and I were just talking about it right before we came on air too, about China. Ralph specifically asking, does Darius think the Chinese stock market is bottoming? I was more curious about what your thoughts were about the Chinese economy. You can answer either one.
Yeah, so the stock market likely has bottomed. It seems like they worked really hard to put a cyclical floor into the market. Now, is that the long-term bottom in the market? Probably not. We believe China's in a structural liquidity trap, much like what we observed in Japan throughout the 90s and into the 2000s. So we just think China is just 20, 30 years lagged, 30, 40 years lagged behind that. So in terms of what we're focused on in China is its contribution to the sustained uptrend in global liquidity. Recall that earlier this week at the National Party Congress, China outlined a 5% GDP target for 2024. They outlined a 3% inflation target for 2024, up from deflation currently. And then they outlined an employment growth target of greater than 12 million net new jobs. Those are very aggressive targets in the context of an economy that is in a structural liquidity trap a la Japan, as well as an economy that has outright deflation in its property sector, which accounts for 25 to 30% of Chinese GDP. So our interpretation of that, which has been the same interpretation since mid-December, when we authored the view that China would front load policy support earlier in 2024, which is partially why we're seeing such a positive and sustained uptrend in global liquidity, is because they are front loading that policy support here in early 2024. And then Tuesday's targets tells us that it's very likely that they actually continue to front load that policy support. So, in terms of how we are recommending clients to manage China risk, we think being invested in other emerging markets is probably the best way to go. India, Brazil have very favorable policy dynamics right now. Emerging markets generally do well in a Goldilocks regime. So if you want to see market risk broaden out, I'd be looking international. I'd be thinking EM. China's probably going to perform because, again, they're stimulating. But again, I don't know that I can ever, with a straight face, recommend that an investor puts their hard-earned money in a Chinese stock.
Great way to think about that, because the liquidity boost is going to lift those boats, but then you maybe help moderate your
The geopolitics is
yeah,
so
the
massive.
geopolitics, just the economic stewardship really issue. That's fantastic. We've got some really good questions in here. By the way, Michael presenting another side. Planes in a steep climb will eventually stall. Both of
Yep.
those things can be true, right? Which is why it's so hard sometimes to invest. But Michael, your point is well taken. The Macro Butler asking, what's your view on the U.S. 10-year yield for the next few months?
Yeah, I mean it's flat to sideways. I mean it's kind of the history of the long end of the curve in a Goldilocks regime. So in our opinion, the bond market is not where you should be invested. You should be invested in spread products if you're allocated to fixed income. Goldilocks is a signal to investors to go take risk further out on the risk curve. Go into credit, go into private debt, go into triple C's, go into emerging market local currency bonds, it's a carry trade regime. That's effectively what we're arguing. Is that we're arguing for a continuation of the carry trade regime, primarily because the two dominant themes that are underpinning the Goldilocks regime, i.e., immaculate disinflation and resilient U.S. economy, are likely to persist. And oh, by the way, we're adding this thing called green shoots globally to the theme as well. And so I think if we're having this conversation, let's call it 3 to 6 months later, we think the world, at least on a relative to current expectations, will look a lot better and brighter and healthier.
We love that. We love that idea. Jonas asking, is the breadth of the asset rally, stocks, gold, crypto, bullish?
Is the breadth of the asset. So, Brian, if you go back and throw slide one up again, so this is a good opportunity to explain our global macro risk matrix, which is, in our opinion, one of the more powerful tools that I've seen on the sell side in terms of helping buy side clients stay on the right side of market risk. So this entire model is built on a breadth principle. And so what we're trying to do is identify which regime has the most amount of breadth supporting it at any given time, so that we can orient our portfolio to that regime. And obviously, Goldilocks has been that regime since about mid-November. And how this table works is we're scoring 42 of the most important asset market exposures in the world through the lens of our volatility adjusted momentum signal. If a signal is bullish or bearish, how that market has historically behaved in that particular regime, it'll get a point for that regime, and we run that same process across all the different regimes. So right now, if you go slide 2 up, Brian, Goldilocks has the highest number of breadth, with 12 of those 42 markets confirming it. As you can see right now, the strength of signal is actually quite low because there's not that many markets that are generating a bullish or bearish indication. There's a lot of neutrality in the table, which does not contribute to the breadth statistics. But for now, Goldilocks remains the market regime. We have qualitative reasons from a fundamental standpoint that gives us confidence that Goldilocks, or even if it transitions to inflation, i.e., a risk-on regime, is likely to be sustained over the medium term. And that is supported by the constellation of composite signals on slide 3, Brian, where we show our macro weather model signaling a bullish 3-month outlook for stocks, bullish 3-month outlook for the bond market, bullish 3-month outlook for Bitcoin. And so statistically and qualitatively, from the perspective of our fundamental research, we have reason to believe that a lot of the positive dynamics that have contributed to the bull market you're seeing in crypto, the bull market you're seeing in stocks, are likely to continue. They're not going to continue indefinitely. So we have to continue to refresh this Bayesian process 6 days a week for our clients here at 42 Macro to identify when it stops happening, so that we can reposition our portfolios in time to manage risk. But that's the process. That's the name of the game in a nutshell.
Amazing. Fantastic.
Thank you.
Great questions. And Michael, you get the chat award of the day. He said, I looked at a bunch of China ETFs, all below 200-day moving average. Nothing good happens after midnight or below the 200-day moving average. Very funny.
I
Michael.
disagree, my friend. I disagree. So go back to slide 1, where you see the volatility adjusted momentum signal. Volatility is a leading indicator for price, which is why we don't just use price momentum to determine the momentum of asset markets. We also layer on volatility as that factor. And what you find at market peaks, whether they be cyclical, structural, or market bottoms, the volatility regime changes prior to the price regime. So you're already seeing, if you look at our signal for Chinese equities, Shanghai Composite broke to neutral 2 days ago. And so it's neutral now from bearish. And now that entire ride up to bullishness will be below the 200-day moving average. So you can be making money right now getting a half position allocated to something like Chinese equities from a no position because of that neutral signal, the transition from bearish to neutral. You won't get that neutral signal if you're only looking at price.
Fantastic. Can you imagine what Darius would do on a debate stage when he runs for president?
That
is like mic drop out, but great. And I'm sure Michael appreciates that tip. So add that to your framework as you build it out, Michael, and see if that makes a difference. Darius,
I did come in a real quick tidbit. I did come in second place in speech and debate in Seattle. when I was in high school.
Why is that not surprising? And now with a little more time under your belt, number one, this
Yeah.
is so exciting. Well, now he's our master macro guru and future presidential candidate. Darius, this is one hell of a daily briefing. Fantastic stuff.
Appreciate you, Megan. Appreciate everyone on the Real Vision gang. Great questions. You guys are always a wonderful, engaged audience, and I look forward to next time.
Absolutely. And get in that New York Real Vision chat and tell me who's making the campaign pins, please. Thanks, everybody. Appreciate it. Darius, always great to see you. Thank you so much. Take care and good luck out there, everybody.
Hi. On June 5th and 6th, 2024, I'll be speaking at the largest AI event in Asia, Super AI, in Singapore, at the iconic Marina Bay Sands. Alongside brilliant minds like Benedict Evans, Balaji, and Edward Snowden, I'll be on stage exploring the extraordinary potential of AI and the profound change it represents not just for financial markets, but for the world as we know it. With over 5,000 attendees and over 150 side events, Singapore will become a vibrant AI hub for a full week from June the 3rd to the 9th. Visit realvision.com/super AI to register and join me with 20% off tickets with the code REALVISION, all in caps.